Mining ventures are going gangbusters, but not all investment in the sector is following suit. Capital expenditure in new projects is expected to hit nearly $80 billion this financial year. But there are concerns that rising costs and competition for resources could put the brakes on the boom. Neil Woolridge reports.
For years, Australia's business and economic leaders have been talking up the mining investment boom.
We are continuing to push ahead with all of our large capital projects. We've approved over $10 billion over the past year.
The mining industry is planning to invest a record $76 billion in 2011-12, 8 times more than its annual level before mining boom Mark 1.
Around Australia, that's translating into some eye-popping potential investments. Rio Tinto and BHP Billiton are planning to spend $28 billion in their Pilbara iron ore expansions over several years. A full-scale development at BHP's Olympic Dam could cost $30 billion. And Woodside's Browse gas field comes in at $40 billion. But now some of the more bullish expectations are receding, with Europe's troubles lingering, China's authorities engineering a slowdown, and costs like labour, energy and tax rising.
We're probably seeing mining cost pressures globally 10 to 15% range, and that's a fairly substantial impost in terms of year in, year out cost increases that you've got to try and claw back.
The project that's causing most concern is Olympic Dam. If a full-scale development goes ahead, Olympic Dam is expected to pump $45 billion into the South Australian economy over 30 years. It's been given the go-ahead by the state and federal governments, but BHP's board is still mulling its options, even though it was given just a year before the state approval lapses. Many fear they may well decide to scale back the project.
It's hard to really call that one. I mean, it's certainly in the right commodity area. Copper is certainly one of the favoured minerals at the moment, or metals at the moment, along with iron ore and coal. So it's certainly the right commodity.
There's definitely increased shareholder scrutiny, and I think some of those shareholders are quite vocal in terms of wanting more cash returned up front and less future development.
And despite the recent rush to LNG and coal seam gas, that investment pipeline is also by no means assured. A recent report by Citigroup identifies 18 projects either proposed or under construction worth $330 billion. But Citi warns that $150 billion of that work may not proceed. In a sign of the uncertain environment, Woodside has already delayed a decision on its $40 billion Browse project.
There's probably more prospect of those being scaled back a bit in time, rather more than the commodities we've just talked about. There's probably a little bit more, if you like, degree of freedom in the way in which that expenditure is run out.
However, the Pilbara iron ore expansions by BHP and Rio seem far more assured, given that the price of iron ore is well above the cost of extraction. Still, both investors and politicians will be keenly watching whether the mining investment boom plays out to its full potential. It will have a key role in determining the nation's near-term economic growth and whether Wayne Swan can deliver his much-promised budget surplus.